Welcome back to the deep dive. In a world that often feels like just a chaotic mix of crypto roller coasters and meme stocks, where do you find reliability?
Somewhere calm, right?
Exactly.
Yeah.
Somewhere you can put your money and actually, sleep at night. Today, we're diving deep into SCHD, the Schwab U.S. Dividend Equity ETF.
It doesn't always grab the headlines, that's for sure.
No, but it often delivers. So our mission today, pull out the key nuggets about its income, the yield, and maybe its often overlooked upside potential. Think of it like the dependable valedictorian who never skipped class.
And that dependability is really crucial, I think, especially if you're aiming to be, truly well-informed about building wealth steadily.
Rather than just chasing the latest hot trend.
Exactly. Finding substance, not just superficial flash.
Okay, so let's unpack this. What is SCHD? Fundamentally.
Well, it's definitely not your get-rich-quick ETF.
No, more like your get-rich-slowly and sleep-well ETF.
That's a good way to put it. It was launched by Charles Schwab back in 2011.
Right, so it's been around a while.
Yeah, and it's built this track record quietly. The key thing is how it gets that reliability. It tracks a specific index, the Dow Jones U.S. Dividend 100 Index.
Okay, and what does that mean in practice?
It means there's a really, really rigorous screening process for the companies it holds. We're talking about 100 high-quality U.S. companies.
High quality based on what?
Several things. First, they need at least 10 years of consistent dividend payments. That's a big one.
10 years, okay.
But also financial strength. They look at return on equity, basically, how well a company uses your money, debt to equity, so how much leverage it has, and dividend growth. Plus the usual market cap and liquidity requirements.
So it's a tough club to get into.
Very tough. It's all about ensuring what we call quality yield. Think of it like dollar store batteries versus an Energizer.
Right, one fizzles out, the other just keeps going.
Precisely. It's built for the long haul.
But that 10-year rule, it sounds incredibly strict. Does that mean SCHD might miss out on some, great newer companies, ones that haven't paid dividends for that long yet?
That's a fair point, and yeah, it's a criticism we'll touch on later.
Okay.
But the strictness is deliberate. It automatically filters out more speculative, unproven businesses. It focuses on established players with a proven track record.
So maybe it misses the next big thing in its early days.
Potentially. But in return, you get a foundation of companies that have already shown they can weather storms and keep rewarding shareholders. Resilience.
Okay, so the selection process sounds solid. But what does that translate to, like in actual income hitting your account?
That's the tangible benefit, right? As of mid-2025, the yield is hovering around 3.6%.
3.6%? How does that stack up?
Well, it pretty much smashes the S&P 500's average yield, which is closer to, 1.5%?
Yeah, around there.
And it's comfortably beating most savings accounts or CDs these days, too. This income stream is really where SCHD shines.
And it's not just the starting yield, is it?
No, absolutely not. What's really compelling is the growth of those dividends over time and consistency.
Growth. How much growth are we talking?
Over the last decade, SCHD has grown its dividend payouts at a compound annual growth rate, a CAGR of roughly 11%.
11% CAGR on dividends. Wow.
Yeah, think about that. If you'd held it for 10 years, your actual income stream from it would have more than doubled.
More than doubled. That's powerful compounding.
It really is. It's like the investing version of having your cake and eating it, too.
Uh-huh. Yeah.
And for people needing predictable cash flow, like retirees maybe, it pays out reliably every quarter, consistent cash every 3 months.
And what about taxes? Dividends can sometimes be a headache there.
That's another advantage of the ETF structure here. Most of SCHD's distributions are qualified dividends. Meaning they generally get taxed at the lower long-term capital gains rates, not your ordinary income rate. Depends on your tax bracket, of course, but it's usually 0%, 15%, or 20%.
So less of a tax bite, less IRS-induced trauma, maybe.
Exactly. It adds to that whole sleep well at night factor we mentioned.
Okay, so if it's this curated basket, not just random stocks.
Yeah.
What's actually inside? What kind of American business muscle are we talking about?
Right, let's look under the hood. As of mid-2025, you see names like Broadcom, PepsiCo, Cisco, Amgen, Texas Instruments.
Big names. Recognizable.
Definitely. Pfizer, Coca-Cola, Verizon, Merck, 3M. These are established powerhouses.
And importantly, what's not in there?
Ah, yes. You won't find, highly speculative stuff, no crypto ventures, no early-stage EV companies that might be in a bubble, no AI startups bleeding cash.
Just real companies making real profits.
That's the philosophy. It implicitly avoids hype cycles by focusing on that profitability track record. It's kind of a quiet rebellion against market frenzy.
And looking at the sectors, how's the diversification?
It's pretty well spread out. Information technology is the biggest slice, around 21%. Then you've got industrials at about 16%, healthcare 15%, consumer staples near 13%, financials around 12%.
So not just like utilities and banks.
No, not at all. It's not just your grandma's dividend portfolio.
Wow.
It's a mix of defensive sectors and some growth-oriented ones like tech and industrials. It's like a well-balanced investment buffet. Offers a bit of everything, but focuses on quality ingredients.
Okay, good analogy. Now let's tackle the elephant in the room, capital appreciation. People hear dividend ETF and think income, income, income.
Right. They assume that's the whole story.
But SCHD actually grows in value too, doesn't it?
Yeah.
I've heard it can even outperform the S&P 500 sometimes.
It absolutely can and has, especially during markets that are going sideways or even down markets. That quality focus helps cushion the blows.
So what do the numbers look like on total return, not just yield?
Okay, looking back as of mid-2025, the 5-year annualized return was around 10.5%.
10.5%.
Okay, and the 10-year annualized return, roughly 11.2%.
11.2. How does that compare to, say, the S&P 500 over 10 years?
The S&P 500's 10-year return was around 12.3% annually during that same period.
This is slightly less than the S&P 500, but pretty close.
Exactly. It isn't lagging by a huge margin, especially when you consider
Lower volatility.
Yes, significantly lower volatility, and you're getting that higher income stream along the way.
But just playing devil's advocate for a sec, if someone's purely focused on maximum gains during a roaring bull market, maybe SCHD isn't the absolute top performer. They might leave some upside on the table compared to, say, a pure growth fund.
That's a fair point to raise. Look, SCHD probably won't give you that, 50% pop in a single year like some super speculative tech rocket might, if that rocket takes off.
Right.
But the flip side is you're also far less likely to wake up to a sudden minus 30% drop because, I don't know, the CEO tweeted something crazy or earnings missed by a penny.
A different risk-reward profile.
Entirely. It's built for endurance, not just sprints, more of a marathon runner.
Which brings us nicely to that downside protection, that sleep well at night factor we keep coming back to.
Yeah, the durability.
Yeah.
It comes directly from that focus on high-quality, cash-generating businesses.
Do we have an example? Like, how did it hold up recently?
Oh, absolutely. Look at the market drawdown in 2022. That was a rough year. The S&P 500 fell over 18%.
Ouch. Yeah, I remember.
SCHD, it only dropped about 10%.
Wow, that's a significant difference.
Huge difference. Now, no investment is totally immune, but it cushions the fall remarkably well, and it tends to recover faster, hit new highs with less drama.
So it's the kind of thing you could give to a more nervous investor.
Totally. Someone who sees every dip as the end of the world. You could say, look, just hold this, chill out. It's built for that kind of stability.
Okay, let's do a quick comparison round, like a would you rather for dividend ETFs.
All right, I'm ready.
First up, SCHD versus VYM, the Vanguard High Dividend Yield ETF. What's the difference?
Okay, VYM generally focuses more purely on high current yield. SCHD puts a stronger emphasis on dividend growth alongside yield.
So quality and growth matter more for SCHD.
Yes, the screening is arguably tighter on quality metrics. Historically, SCHD has often shown better 5-year returns as well. So, verdict. SCHD tends to edge out VYM on total return and those growth metrics.
Got it. Next, SCHD versus DVY, the iShares Select Dividend ETF.
DVY is interesting. It tends to hold older, sometimes more utility-heavy companies. It feels a bit more traditional.
Like a dividend boomer versus a dividend millennial?
Maybe something like that.
Yeah.
SCHD's focus on dividend growth is stronger, and its expense ratio is also lower than DVY's.
Okay.
The DVY has its place, but SCHD feels maybe more dynamic for today's market.
Okay, makes sense. Last one, and this is a popular comparison, SCHD versus JEPI, the JP Morgan Equity Premium Income ETF.
Ah, JEPI, the yield monster.
Right. It boasts a much higher yield, often 6–10%. How does it do that? What's the catch?
JPI gets that high yield using options, specifically selling covered calls on its holdings. It's an income generation strategy.
Okay.
The potential downsides. Its total return has often lagged SCHD's, especially in strong up markets, because those covered calls can cap the upside. Also, the tax treatment of the income from options is more complex, often taxed as ordinary income, not qualified dividends.
So SCHD relies on company fundamentals and profit growth for its dividends.
Exactly. Solid fundamentals, not financial engineering or, options gimmicks, as some might call them.
So the verdict, SCHD versus JEPI.
JEPI might appeal more to pure income chasers who need the absolute highest current payout. SCHD is generally seen as better for long-term wealth builders, focused on both growing income and capital appreciation, different tools for different jobs.
All right, so bringing it to the present moment, mid-2025, we've got the Fed maybe holding rates steady, inflation is cooling but still kind of sticky, and the market's torn, soft landing, recession. Why SCHD now?
Well, in this kind of uncertain environment, SCHD is arguably really well positioned.
How so?
High-quality dividend stocks, the kind SCHD holds, historically tend to outperform during periods of volatility. They offer a bit of a safe harbor.
Okay, that makes sense.
Plus, those rising dividend payouts we talked about, they act as a natural hedge against lingering inflation. Your income stream keeps pace, or tries to.
Preserves purchasing power.
Exactly. And valuation-wise, it's generally remained pretty reasonable. The PE ratio often hovers around 15x, which isn't crazy expensive compared to the broader market sometimes.
So it's not about timing the market?
No, definitely not.
Right.
If you're trying to perfectly time the market, well, good luck with that. SCHD is more about building wealth sustainably, consistently, through whatever the market throws at you. It's a tool for that steady approach.
Okay, that's a strong case. So let's say a listener is convinced, or at least intrigued. How should they think about fitting SCHD into their portfolio? Is it a core holding? A supplement?
It can absolutely be a core holding. I really see it as a foundational ETF for many portfolios.
Foundational how?
Well, it could be your main income position. It could replace maybe some expensive active mutual funds you hold. It's perfect for anchoring a retirement portfolio where you need those consistent payouts.
It's just the dividend part of a bigger strategy.
Yeah, the dividend engine within a broader total return strategy. And, connecting it back, you could easily pair SCHD with something more growth-focused, like QQQ, the NASDAQ 100 ETF for tech exposure, or maybe VUG, the Vanguard Growth ETF. That way you get a blend the steady income and stability from SCHD plus the potential for higher growth elsewhere. Best of both worlds, potentially.
Okay. Now, we need to be balanced. No investment is perfect. What do the critics, the naysayers, say about SCHD?
Right. It's important to address the downsides. There are a few common points.
Such as?
First, it's 100% U.S. stocks, no international exposure.
Okay, that's a fair point for diversification.
Second, there is some concentration risk. The top 10 holdings make up a significant chunk, around 40% of the ETF.
So you're heavily reliant on those top names.
To a degree, yes. And third, back to what you asked earlier, that 10-year dividend rule, the dividend cliff, some call it, it does mean it misses out on newer, potentially fast-growing companies that haven't hit that decade mark yet.
So how do you respond to those criticisms if someone's building a portfolio?
Well, the main response is that SCHD isn't trying to be everything to everyone. Its purpose is stability, quality, and growing income from established U.S. companies. It's a specific tool.
Exactly. You wouldn't blame your hammer for not being a screwdriver. If you want international diversification, you add an international ETF like VX U.S. or VYMI alongside it.
Makes sense.
Want small cap exposure? Add IJR or VBR. You layer these things. SCHD excels at its specific job, and you combine it with other tools for a complete toolkit. Don't blame the toolbox for not being a Swiss Army knife.
Good way to put it. Okay, let's try and wrap this up then. Recapping SCHD's strengths.
It's reliable, right? Over a decade of strong dividend growth.
Definitely reliable.
It's generous, that 3.6% yield, but more importantly, the growing payouts.
Generous and growing, yes.
It's stable.
Yeah.
We saw how it holds up better in downturns, less volatile.
That sleep well at night factor is real.
And accessible. That tiny 0.06% expense ratio is hard to beat.
Very low cost, very accessible.
So maybe it's underappreciated because, like you said, it doesn't trend on Twitter.
No, it doesn't get the hype.
But it sure seems to trend up over the long term. So if you're tired of the hype and want something dependable, SCHD isn't just safe, it feels smart.
I think that's the perfect word.
Yeah.
Smart. And it really highlights the maybe quiet power of this kind of investing. While everyone else is juggling Teslas and Dogecoin and hot takes on TikTok, SCHD is just doing its job, making you money, paying you quarterly, and not really asking for any attention. It proves you don't need to chase every shiny new thing to build real substantial wealth.
So ignore the noise, Focus on the quality.
Pretty much. It's a testament that consistent, disciplined investing in proven businesses works. It's definitely a keeper in almost any long-term portfolio, I'd say.